So right now there's a headline everywhere saying that Trump wants to cap credit card interest rates at just 10%. And on the surface level, that sounds pretty incredible. And we're going to talk about what this actually means and what's missing from the headline and how this could help you, but also how this could hurt you depending on how you prepare. And most importantly, I'm going to show you what to do whether this happens or not, because your debt does not pause because of politics. Now, first, let's actually get something very, very clear that this is a proposal and not an actual law, because presidents can suggest ideas, but they don't set the credit card interest rates. And for something like this to happen, it will require Congress, a legal framework, enforcement rules, and cooperation from lenders, and none of that is guaranteed, and none of it happens fast. If a 10% cap actually went into effect, there would be real benefits for people already carrying balances. Lower interest rates means more of your payments go towards the balance instead of the actual interest. And that can speed up your payoff only if behavior stays the same. So let's make this real simple. Let's just say that you owe $5,000 and you can pay $200 a month. 25 to 30% interest, a large portion of that payment is your interest. At 10%, more of it attacks the actual balance. But nothing disappears, and this only works if payments continue and balances do not continue to grow. Now, this is the part that most people do not talk about. Banks price risk using interest rates, and if you cap the rate, the risk does not disappear, and banks just adjust elsewhere. And what that can mean is tighter approvals, lower limits, more fees, fewer rewards, and accounts actually being closed. When access tightens up, it doesn't hit everyone equally. Strong credit borrowers usually will still qualify for the things that they want. But people with lower scores, high utilization, thin credit files, these borrowers will feel it first. Now, whether this proposal passes or not, your balances still exist, and interest is still compounding, and your score is still fluctuating. Now, let's just assume the best case scenario. Rates do drop 25 to 30% to 10% for 1 year. That is simply just a window. It's temporary. So rule number one, do not waste the window. Lower interest rates will tempt people to spend more. And if you add balances while the rates are lower, you erase the actual benefit. And you set yourself up for pain if it rises again. If your payment stays the same, the interest savings must go straight to your principal, and that's how temporary relief becomes permanent progress for you. Now, during this rate cap window, avalanche strategies will probably work best for most people. So what you want to do is target the highest APR card first, and if rates are temporarily equal, attack the largest balance you can realistically eliminate. Never plan as if the cap is permanent. Assume rates will return. The goal is to shrink the balances so much that the higher rates no longer control you. This strategy still works even if nothing changes politically. So you can negotiate rates now, you can lower your credit utilization now, and you can reduce interest damage now. Same discipline, same outcome. Now here's the truth in very simple terms. Lower rates help, access matters, but behavior beats any headline that might excite you.